Every AI headline this week is about the stock market. Chip stocks ripping, a Korean chip maker up 14% on its first day of trading. But the most important thing that happened this week wasn't in the stock market at all, it was in the bond market, and it was quiet.
It usually is. The stock market is where the story gets told. The bond market is where the money actually decides whether it believes the story. And right now, those two are starting to disagree.
Let's set the scene. To build artificial intelligence, the largest companies in the world, Alphabet, Amazon, Microsoft, Meta, Oracle, are borrowing money, not a little. Elena, give people the number.
As of this week, those 5 companies have issued roughly $194 billion of debt this year. That is about 9% of all the investment-grade corporate debt sold in the entire market. 5 companies, 9% of everything. And if you widen the lens to all AI-related borrowing, the data centers, the private financing, the power deals, the figure for this year is well over $500 billion, roughly double last year.
Well over $500 billion to build something most people still think of as software. So the first thing to sit with is that AI is not a digital story. It's a physical, financed, borrowed money story. And that changes who you should be watching.
It moves the important audience from equity investors to credit investors. And credit investors have a very different job. An equity investor asks, how high can this go? A credit investor asks, will I get paid back? That second question is far less romantic and far more revealing.
So what are the credit investors doing?
They're starting to step back. One of the largest asset managers in the world has publicly said it's wary. The phrase being used is that investors aren't well compensated for the risk because these bonds trade at only a small premium over government debt. You are lending to a decades-long, unproven, capital-hungry buildout and being paid almost the same as if you'd lent to the government. Little reward and a great deal that could go wrong.
And this is the part that matters. The price is starting to move. Walk through the chain because the chain is the whole point.
Here's the chain. Step 1, the companies issue enormous, very long-dated debt, some of it maturing in the 2060s. Step 2, to place that much debt, they have to offer more yield, so the risk premium, the spread, begins to widen. Step 3, and this is the tell, those AI-linked spreads are widening, even while ordinary corporate bonds barely move. That divergence is the signal. It means the market isn't nervous about the economy. It's nervous specifically about this.
And step 4?
Step 4 is the one nobody wants to say out loud. When the cost of the debt reprices, the economics of the whole build-out reprice with it. These projects are justified on the assumption that money stays cheap for 20, 30 years. If the lenders demand more, the math on every data center gets harder. And the equity story that sits on top of it has to reprice too. In markets, the debt almost always moves first. The bond market is the adult in the room. The stock market is the last to admit the party is ending.
And we should be honest that this has a history. This rhymes.
It rhymes with the telecom buildout at the end of the 1990s. Enormous borrowing to build physical infrastructure, back then fiber optic cable, on the belief that demand would be limitless. The technology was real. The internet did change everything. But the debt was too big and too early, and when the financing turned, the companies that had borrowed the most were the ones that broke. The lesson was never that the technology was fake. The lesson was that the balance sheet couldn't wait for the technology.
That's the distinction a serious person should take away. This is not a claim that AI is a hoax or that the demand isn't real. It's a narrower, harder point. The way it is being financed is fragile, and the fragility shows up in the credit market before it shows up anywhere else.
Which is why the number to watch is not the chip stock, it's the spread. If AI-related bond spreads keep widening while the broad market stays calm, that is the market quietly telling you it is losing faith in the financing, regardless of what the equity chart does on any given day.
We flagged the shape of this in early July, when Oracle's own filings showed how much of the build-out was being carried on borrowed money. This week, the bond market started to price it. That is the sequence we care about. The physical commitment, then the financial strain, then eventually the headline everyone reacts to.
And by the time it is the headline, the repricing is mostly done. The people who watched the debt were early. The people who watched the stock were on time. The people who waited for the news were late.
So the takeaway for anyone with real exposure here, a portfolio, a business that depends on cheap capital, or a career built on this boom, is simple. Don't watch the ticker, watch the debt.
Because the AI trade isn't cracking in the stock market. It's cracking in the bond market. It's just being polite about it.
We'll keep tracking the spread. This has been the physical chain.